Hi, thanks so much for joining in. You're watching the Mutual Fund Show on BQ Prime, and my name is Alex Mathew. Multi-cap funds, that is the topic of the conversation today. Now, just a short while back, just a couple of years back, this was the largest or one of the largest categories in the mutual fund industry, in the equity segment. And that changed when the markets regulator came in and changed the definition of multi-cap funds. It stipulated that 25% of the assets under management in these funds has to go into each small cap, mid cap, and large cap. And the last 25% can be allocated as the fund manager sees fit. At the time, mutual fund houses were given the option of making those changes in their multi-cap schemes or to transition their existing schemes into what was called a Flexi cap category. A lot of mutual fund houses chose to do the latter. Now, we're talking about multi-cap funds today because it so happens that Edelweiss Mutual Fund has a new fund offer, multi-cap fund, and we'd like to talk to them about it. Joining me is Radhika Gupta, the Managing Director and Chief Executive Officer of Edelweiss MF, and Trideep Bhattacharya, the CIO of Edelweiss MF. Thank you so much for taking the time. Let me ask the first and the most important question at this juncture to set the context also, is that you chose, as I said, to take the latter approach, which is to transition to the Flexi cap. You have quite a few assets under that scheme. I guess to a certain extent, a lot of people felt at the time, Radhika, that the new norms as they were a little restrictive, which is why they moved to Flexi cap. So why are we launching multi-cap now?
Sure. So thanks, Alex. Good to be here. So I think the history was a little bit old and more has happened in that history. Now, when we had the option, our fund was running as a flexi cap fund in nature. It was benchmarked to NSE 500. It had about 70 or 60% large cap exposure, the balance mid and small. We always focus on creating minimal disruption to existing investors. So we took our what was erstwhile multi-cap fund and made it a flexi cap fund because we didn't want to do unnecessary buying and selling of securities. We had a particular mandate and we migrated our fund. As far as launching a new fund is concerned, we are a little thoughtful and we don't launch NFOs just because the category has opened. We like to evaluate market conditions, we like to evaluate liquidity, and we like to evaluate our basket more completely. Now, I think a few years since this event has happened, one, our own equity capabilities and team has substantially expanded, and I think Trideep can talk about that. But I think the clear differentiation between both funds is available. SEBI has also got mandatory benchmarking on both schemes, and the current flexi cap schemes are benchmarked to NSE 500. NSE 500 is a benchmark with 75% large cap exposure, which means that your flexi cap fund is now going to run as a predominantly large cap funds, and really benchmarks govern how schemes are run. We feel that if you look at the structure of the Indian market today, really mid and small cap as a segment has expanded. In 20 years ago, the average size of a large cap company was 3,000 crores. Today, the average size of a small cap company is 12,000 crores. And if you really want to capture the best of India's opportunities, we do believe it can't be only large cap, because while banking and financial services leaders are present in large caps, many of the leaders in capital goods, in China plus one themes, in diagnostics and capital markets are present in mid and small cap. So the default portfolio has to now move to a blend of large, mid, and small. The multi-cap fund construct lets us do this. Its benchmark is a lot more aligned to equal participation across market caps. And that's why we felt it's a good time to launch. In addition, I think we do have the mid and small cap capability this fund requires.
Fantastic. Trideep, I'll come to you on this next question, because at a time when we're looking at tremendous flows into small cap and mid cap, because of the outperformance in the year-to-date period, there are some questions about whether or not the valuation picture is as attractive as it has been at the start. And I think that's a fair question to ask. You're launching the scheme at a time when that question is being asked more often than it has in past weeks. Is that going to pose a challenge for you?
In fact, I would turn it around and say that while we have a very successful mid and small cap fund with robust track record, and we have been strong proponents of mid and small cap investing over the last couple of years. Given where valuations are, given that we have seen already a 40 to 50% rally in mid and small caps, we think that the incremental money today should probably go into a balanced portfolio, balanced across large, mid, and small cap as a stocks. So when we at Edelweiss, we sat together to think what could be that alternative, and hence what NFO to come with, if we do come up with, rather than going with a thematic fund, we thought this is the best way to best solution for investors given where valuations are for mid and small caps, and as present as an alternative to investors overall. The other point I would say that after having seen a good amount of rally in mid and small caps, there are some pockets of irrational exuberance that are present in that segment. But that is not to say that mid and small caps as a space is uninvestable. In fact, if you ask me, we believe that this is India's decade, and over the next 4 or 5 years, once we navigate through this volatility, which includes national elections, this, that, the other, we think that the next 4 or 5 years, India could see a strong runway for growth, driven by various different factors. And to capture that, one needs to have exposure in mid and small caps. What we are saying though now is we need to be a little more selective, and hence a multi-cap portfolio or a multi-cap construct helps us do that in the context of a similar, in context of one portfolio. And hence we are kind of taking the multi-cap approach of investing for incremental money, and that's our suggestion for investors as well.
Okay, Radhika, in terms of the drawbacks of this particular category, and you mentioned the Flexi cap tends to mirror the benchmark as well, and 75%, I think by and large, most mutual fund schemes in this category in Flexi cap are above that 75% mark. The drawback, as I see it, and correct me if I'm wrong, is that in the event of a downturn, because you are restricted in having to have 25% each in mid and small cap, the possibility of a drawdown in that situation would be quite significant. Is that something that you are, through your partners, distribution partners, educating people about? And is there a investor type that you think should look at this very closely?
So I think that I'll answer the second question first. I think this will be the default portfolio for the future, because to Trideep's point and my point earlier, if you look at the structure of the Indian economy, I think you need to capture opportunities across market cap. And we also as a house are a big believer in bundled solutions. You can't have mid and small cap exposure today. Markets change, then you do market timing. Firstly, it's very hard to do market timing. You switch to large cap, you pay a lot of tax, then you move to mid and small cap again. I think the power of having things in one solution is really underrated. We've seen that with the success of hybrid funds. We've seen that with the success of our own gold and silver fund. I think having a single solution is very powerful, in a world where you pay taxes and there are costs to rebalancing. So I think the product is really for everyone in that sense. It is your default equity allocator. If you want to call it dumb asset allocation, call it that. Now, as far as volatility is concerned, I think we intend to run this as a broadly 40% large cap, 30 mid, 30 small fund, which means 60% is mid and small cap exposure. And of course, we are making that fact amply clear. If we wanted to run one more large cap biased fund, there was frankly no need to launch that fund. Will the risk be a notch higher? Of course, it will be a notch higher than running a pure play large cap fund. Will the returns be a notch higher? I think the historical data suggests that the returns will also be a couple of notches higher. Interestingly, when we look at the data on a risk-adjusted return basis, I think multi-cap stacks up well. So, investors are being rewarded for the incremental risk that they're taking.
Fair point. I want to come to the nitty-gritties of Trideep, the selection and the thesis behind this particular scheme. And I think in a sense, it will reflect what is across your other portfolios as well. But as Radhika pointed out, certain allocations are possible because of the nature of this particular scheme. So would you be able to give me a sense of how the portfolio will reflect that? What will the contours be?
So I think overall, I would say that, if you look at a bit of an equity market outlook, is probably kind of will set the context, and hence the portfolio will be run the way it will be. And I would set the context as that if you look at the macro today, whether you look at global macro or local macro, punctuated by the fact that the 10-year bond yield in the United States have reached levels that reached in 2007, the weaker global recovery, etc. I think it makes sense to say that global and local macro is reasonably negative. And hence, the way we want to sort of run the multi-cap fund on an ongoing basis is basically focusing the portfolio on what I call as pockets of earnings resilience. These pockets of earnings resilience are selected on a bottom-up basis and basically presents itself, earnings tailwinds, which are more than just the normal ones. And what that means is, even in a tough macro environment, these are the areas where we will have limited earnings downgrades, if any, or in a positive macro environment, we could see, a better earnings upgrades to come through. This is what I would call as a, heads I win more, tails I lose less kind of a way of thinking. And based on this sort of construct, we've come about 5 areas of pockets of earnings resilience, which is what I would say about 70 to 75% of our fund would be oriented towards. These 5 areas are briefly, and we can go into details if needed. First, we are positive about CapEx as a theme. We think that we are in the middle of a manufacturing upcycle driven by private sector CapEx over the next 2 to 3 years. Second, we think that lending financials are in a good spot right now. I would call it going through a Goldilocks moment with both growth and asset quality in the right place where they should be. Third, we think that direct and indirect plays on real estate are a good place to be because real estate is in the middle of a 5 to 7 year upcycle. And we are somewhere in the middle, and there is some more room to go. The fourth and the fifth areas are more emerging, and hence a multi-cap construct helps us better. The fourth area is defense, where indigenization of defense is a decadal opportunity in front of Indian corporates, and we think particularly stocks in mid and small cap can capitalize on the same. And finally, EMS, electronic manufacturing systems, as a theme, in my opinion, is probably even a longer dated theme overall. The sector itself is growing at about 30-odd%. The point really here is that in these areas, there is something more going on than the normal business conditions. And we think a bottom-up portfolio constructed in and around these areas would actually kind of present to investors, a portfolio which is relatively insulated, but at the same time from macro, but at the same time is well-oriented towards growth, and valuations are still not excessive. Okay. So enough of a long-winded answer.
No, it wasn't. I think it perfectly answered my question. No, Trideep, don't worry about that. In fact, I have a follow-up to that, which is that in a lot of schemes that you see across the board, you see a very significant allocation to the financials because you try and play that CapEx story or even the consumption story through these entities, which are central to that. Is that going to be something that you could see in your portfolio as well? I'm talking about a third in some situations of the portfolio, and that I guess is reflective of the bank nifty or rather the nifty composition as well. But is that going to be your focus, or is it going to be manufacturing? Because I looked at the presentation which spoke about manufacturing being the big theme and PLI being opportunities that you see in that manufacturing space.
Exactly. So I think our overarching theme, if you were to look at where we are taking the alphabets, it will be higher in manufacturing than it is in financials. Financials today is a fairly broad construct, by the way. We have lending financials, we have non-lending financials in the form of, capital market players, depositories, and a whole bunch of other players. So in that context, we are talking about a specific subsegment within financials, which is the lending financials, which we are positive on. Whereas in manufacturing, we are more broad-based, I would say, whether it's capital goods, whether it's construction, and also defense, it could be a subsector, if you can call it that way. So we are more broadly overweight manufacturing, underweight or selective in consumption. Our consumption-related bets are more oriented towards urban consumption bets. And in that context, financials would come second or third in areas that we are betting on, because we are betting on a sub-segment, which is lending financials. And it is, in a way, linked to the manufacturing as a theme, because manufacturing, as you know, needs capital creation. And as part of capital creation, you need credit growth. And credit growth is what banks provide. So it is linked in a way. but we want to capture that part of the financials rather than anything and everything that falls under that category.
Fantastic. So, Radhika, did you have a point to add?
Yeah, I wanted to make a tiny point. And I think one of the things that distinguishes multi-cap is that if you look at the large cap universe, the flexi cap universe, because of this NSE 500 benchmark, financials ends up being 35-40% of that benchmark, which is why, Alex, you see what you said, portfolios heavily dominated by financials. In a multi-cap construct, because the benchmark is a lot more spread across sectors, your sectoral split is a lot less concentrated. Trideep talked about what we will intend to do, but the portfolio structurally lets us be a lot less concentrated towards financials.
No, that's a fair point. Radhika, Trideep, thank you so much for joining in and for giving us that perspective. I'm sure our viewers have a much clearer concept of what to expect going forward.
Thanks for inviting us to the show. Thank you.
All right, so that was the management of Edelweiss MF speaking about the multi-cap fund that they are currently offering through an NFO. But let's talk about the category and let's talk about what your approach should be as a retail investor. Joining me now is Prableen Bajpai, founder Finfix, as well as Vishal Dhawan, founder and chief executive officer of Plan Ahead Wealth Advisors. Thank you so much to the both of you for taking the time. Now, I must point out that when I spoke to Edelweiss MF about their multi-cap fund, I provided the context and the fact that this was required because of the SEBI regulation change, which required 25% into mid, small, and large cap stocks. And a lot of fund houses at that point chose the flexi cap route. And I said, why are you launching a multi-cap now? So they said that the flexi cap benchmarking is with the NSE 500, and that has a large cap bias. The multi-cap route allows for allocation to stocks that are not necessarily getting a representation in the flexi cap category. I'm curious to find out what you guys think about this and what you think about the multi-cap category as a whole. Prableen, I'll start with you.
Right. Thanks, Alex. Great to be here. Absolutely. I think multi-cap space is the newest category, in the diversified space. SEBI in 2020 came up with a observation that the multi-caps then had almost 80% in large cap stocks, and that is why they mandated this 25% each to large, mid, and small caps. And as you said, majority of the fund houses actually chose to sort of continue with the large cap tilt and change the structure to a flexi cap, which was essentially the earlier multi-cap, and then it continued as a flexi cap. And if we look at the 22 funds as of now, there are only about 4 funds which are actually 10 years old and about 2 others which are 6 and 4 years old. So there are not too many funds which have a very old track record. And like you said, very few ones continued. Now, the rationale that they have given, I think it's right, because a lot of, broader categories, diversified space funds that we see, Alex, are usually large cap tilted, and definitely the flexi cap category is one of them. So a multi-cap space, I think, is a good combination of, different market caps. It definitely brings in the true diversification in terms of market cap, but also it brings in the added risk because 50% of your allocations are towards the small and the mid caps. Having said that, I think it is not a category which is for everybody. It is for those who understand the kind of risk that they're going to undertake. And I think a little trouble here is only we haven't really seen, because the restructuring happened in 2020. And if we look at how the different market, the large, mid, and small caps have performed since then, 2020 was phenomenal for all the 3 spaces. If we look at Nifty 50, 150, and the mid caps, the small cap 250 index, all of them were really good in terms of performance. 2021 again was a phenomenal year. 2022 we saw some dullness, but 2023 again has been great. So, till now, whatever we've seen in the category is good performance, and we haven't seen a time like 2018 where the large caps were up by 3% and mid cap index was down by 13% and small cap was down by about 27%. So I think the true potential will only be revealed with time. But yes, I think it's a good combination. It's a good category to be in, young and yet to be tested.
Okay. Vishal, any thoughts before we get into the nitty-gritties of it?
Yeah, so actually, I think it's a good idea to step back a little bit and ask yourself, saying, what is an investor really seeking when he chooses to go to a category which is flexible in its approach, whether it is a flexi cap category or a multi-cap category. Our experience has been that what most investors are saying is that let's leave this decision to the fund manager to decide on whether he wants to be in a larger company or in a small size company or a mid-sized company, because I don't have the skill to make that decision in any form whatsoever. And I think my fund manager will do that well. Now, the moment that becomes the approach of the investor, clearly the flexi cap category becomes a default choice because it doesn't have any of the restrictions that the multi-cap category comes with, in terms of saying you need to have a minimum 25% in mid cap, minimum 25% in small cap, and the large cap 25%, and then the rest you can do whatever you want. So very clearly, I think there's a very natural fit of the flexi cap category with the investor's need. And therefore, our sense is that, if this question is posed to the investor and sort of explained to him in the way that these are structured, it's most likely that in most environments, the investor would prefer a flexi cap fund over a multi-cap fund.
Okay, fair point. So since we're talking about this in terms of a versus between a flexi cap and multi-cap, I'm guessing that both of you have also studied to a certain extent. And I take your point, Prableen, when you pointed out that the history of quite a few of these schemes is not as deep, and so therefore will not provide you with a relevant comparison or a complete comparison between the two. Would you say it's fair to compare, though, first of all? And second, if you were to compare in terms of actual performance, is there any benchmark that you can draw, or not benchmark, but any comparisons that you can draw?
It's a different category, Alex, because flexi cap is, it's like the multi-caps became the flexi cap. I think that is why we have this comparison natural. It is quite natural. And I personally feel that, looking at, because we don't have the track records, if we look at Nifty 500 returns, and if we look at Nifty 50, 25, 25, there's another index which is there. If we look at the returns of those two, just for comparison's sake, definitely the one which has the mid cap and the small cap exposure has outperformed over different time periods. And I'm looking at SIP returns here. Because I think multi-cap as a category, because we are having exposure to small caps, and that is a decent exposure, 25%, and to mid-caps, another 25% at all times. I think a staggered approach or a SIP approach is going to be better here, definitely. So if you look at the returns in terms of SIPs, it has outperformed, and it should, because we are also undertaking higher risks. So flexi caps, I think majority moved into the flexi cap category, which were earlier multi-cap, because they wanted to probably maintain the large cap tilt.
Yes.
So I think SEBI, when initially it came up with the restructuring that you have to be defined what is large cap, mid cap, it gave a 3-year period to all AMCs. But it came with the observation that none of them were actually using the flexibility to the level that they should have been probably using. And that is why we have this structured product. But I think it's a good product, Alex, for those who understand that, the kind of risk that they are going to undertake. And I do feel that it does have the return potentials, it does offer the return potential. So I would go in for a multi-cap for those who understand the matrix of how the fund is structured, and also who are looking to have, a higher mid and a small cap exposure through a diversified fund.
Interesting, very interesting point. And so we're getting two slightly differing views here. One is saying that flexi cap might just be preferred, and the other is saying that the nuanced investor, or perhaps someone that understands the risk involved. And by the way, Edelweiss management also spoke about what the likely categorization of their fund will look like in terms of market capitalization tilt. And it was said that it would likely be 40, 30, 30 in terms of large cap being 40 and then mid and small cap being 30, 30. So they will be, in that sense, true to label. But having said that, Prableen, just to follow up before I toss it back to Vishal on this one, when you're saying that an investor can potentially look at it as an option, where does it fit in their portfolio? Because a lot of the time when we're saying that we're building an equity portfolio as well, it's not just one product. You're diversifying there as well. So how should they look at the allocation towards a scheme like this?
So I feel, Alex, that I think it's a good fit in a combination for somebody who has passive funds as well.
Sure.
So let's say somebody having a long-term portfolio has a large cap passive fund in combination, let's say with a mid-cap 150 index fund. So that's your core. And here the multi-cap space can actually give them some exposure to large and mid-caps and in pockets which, where probably there is scope for value investing.
In the meanwhile, let me go to you, Vishal. So would you say that that is the right thinking to have, that it can be used in combination, or will you still stick with your view that that flexi cap is the way to go?
So I think there's 2-3 different elements here that need to be looked at very closely. I think first of all, as an investor or even as an advisor, there's a set of people who like discipline to be very high, and the ranges that are available to be limited for a fund manager in order to be able to make choices in terms of which market cap he or she can buy into. Now, those sets of investors will find multi-cap very interesting because that 25% flexibility is all that the fund manager has to be able to make those decisions, in contrast to something like a flexi cap fund, where literally you are leaving it up to the fund manager to decide whatever he or she wants to do. And therefore, those sets of people who have great trust in fund managers and their abilities will find it comfortable to go to a flexi cap fund. Those who want to give that flexibility, but with limits defined around it, will prefer to look at multi-cap as an alternative. The second thing that is an important part of this decision is essentially to say how much of this is being made on the basis of the last few years of track records of multi-cap funds versus flexi cap. And clearly, because the mid-cap and small cap space have done relatively better than large caps, you could end up finding that on a trailing basis, multi-cap funds could actually be delivering or have delivered a higher rate of return thus far, which could change if the multi-cap and if the mid-cap and small cap space start to underperform going forward.
Fair point.
And therefore, if your decision is being made on the basis of past returns, there is a real risk that you could end up buying the wrong
I was going to come
because
to that.
you made it on that basis.
I was going to come to that with that significant caveat, because I think we've been screaming from the rooftops as well, based on what we've been seeing in terms of inflows into small cap and mid cap actively managed funds. It's been absolutely staggering, the kind of investment, over 50,000 crore in the year so far, 2023. So with that in mind, and I think we're at the close of this conversation, and with the caveat that this has a larger amount of risk than your flexi cap fund, do you have any schemes that you have looked at that you think have the potential or have enough of a track record for you to say that perhaps you can look at these and choose from among these? Prableen, first to you.
I'll totally agree with what Vishal has mentioned about, that recency bias can be very high at this point, Alex. So I think that is something that investors have to be very careful about. And that is why I think a staggered approach into the category generally is better. Out of, if I have to name certain funds, because we don't have too many with a track record, and that too, when the track record is available, it is not for the structure, that wasn't in place. So it's hard to say how they will perform in terms of this rigid structure going forward. But I think Nippon is one. And I'll name 3 others from HDFC, SBI, and Kotak. And this is on the rationale that I feel all these fund houses have delivered great performance in their respective mid caps and small cap categories. So I think these are fund houses which have the expertise to manage these market cap, companies. The stock picking has been great because their individual schemes from these categories have done quite well and have been consistent performers. So I think these are the 4 AMCs I would go with. And other than these, ICICI, Invesco, I think they look fine too. And investors have to, of course, it comes with a disclaimer that they have to do their own due diligence before investing.
Absolutely, no doubt. Vishal, any thoughts here?
Yeah, so I think in addition to the staggered approach that Prableen mentioned, it's also important to, I think, have a long enough investment horizon for these funds. Clearly, we think, at least 7 to 10 years for you to be able to ride through, what can happen with mid and small caps. I think two of the funds that Prableen mentioned, which is essentially Nippon and HDFC, are both funds that we would suggest investors look at as well. HDFC is about to finish 3 years in December. So in the normal course, we would have been a little hesitant, but like Prableen said, not a lot of track records in this category, especially, as multi-cap funds with the mandate that SEBI put out. So therefore, those would be our top two choices if investors are looking, as long as they take at least a 7 to 10 year view with their investment.
Fantastic. Thank you so much to the both of you for joining in and for giving us the perspective that you did. Pleasure speaking with you as always.
Thank you so much.
All right, viewers, there you have it. Multi-cap as a category has been discussed quite deeply today. Let us know what you think, and hopefully this conversation has been beneficial to you. Do stay tuned, lots more coming up over the course of the day. This is BQ Prime.